Most business owners start with the same question. Should they pay themselves a salary or dividends? But that is only the first decision. The bigger question comes next. Once there is extra cash in the business, where should that money actually go? Hi again, I'm Cindy David, president of Cindy David Financial Group. Today, let's talk about what to do with the extra cash in your business. One option is contributing to an RRSP, a registered retirement savings plan. It allows you to defer taxes while building your retirement savings. Another is a TFSA, or tax-free savings account, where your investments can grow and be withdrawn completely tax-free. Or, depending on your situation, it might make more sense to keep the funds inside your corporation, or even move them into a holding company. And this is where many owners get pulled in the wrong direction. The goal is not to build RRSP room for the sake of just building it. The real goal is to build wealth in the most tax-efficient way possible. That distinction matters. Yes, salary creates RRSP contribution room. Dividends do not. But that does not automatically mean salary is the better answer. For many business owners, the real question is whether paying a salary improves the overall financial plan or just results in more personal tax, higher contributions to the Canada Pension Plan, and less money left to invest. In practice, salary is often most useful when the owner needs personal income for debt qualification. That might mean qualifying for a mortgage on a primary residence, financing a vacation property, or borrowing for another personal use asset. In those situations, reported employment income can be valuable. But if debt financing is no longer needed for those goals, then the case for salary becomes much weaker. At that point, many owners are not trying to create RRSP room. They are trying to keep more money working for them, and that is where the corporation becomes powerful. This is where the real advantage of a corporation comes in. With the small business deduction, active business income is taxed at a much lower rate than top personal tax rates. In simple terms, that means more after-tax dollars stay inside the company to invest. In British Columbia, that can mean roughly 89 cents of every dollar remains after small business corporate tax on the first $500,000 of active business income. That tax deferral is often the real engine behind corporate wealth building. Instead of pulling money out personally, paying high tax on it immediately, and then investing what is left, the business owner can keep more capital inside the company and let that larger base compound. That is often far more valuable than creating RRSP room just because salary makes it possible. There is also the CPP issue. When an owner pays salary through their own corporation, they effectively fund both the employer and employee side of CPP. That is a real out-of-pocket cost. For some owners, CPP is still worthwhile as part of a broader retirement strategy. But for others, especially those who are already building wealth elsewhere, paying a high taxable salary just to maximize CPP may not be the most efficient move. So, the analysis cannot stop at salary creates RRSP room. It has to ask whether salary creates enough planning value to justify the tax and cash flow cost. Now, that does not mean leaving everything in the corporation is automatically perfect either. Corporate investing comes with its own trap. Once passive investment income inside the corporation gets too high, it can start reducing access to the small business deduction. In other words, the very tax advantage that helped build surplus capital in the first place can begin to disappear if too much passive income is generated inside the company. And the tax on passive investment income inside a corporation is punitive. That means the next layer of planning is not just about keeping money in the company. It is about being intentional with what the corporation invests in, how it invests, and how that surplus is structured over time. That is where many owners need to stop thinking in terms of single products, but start thinking in terms of systems, because the right answer is rarely just RRSP, TFSA, or corporate investing. A TFSA still matters because it offers tax-free growth, tax-free withdrawals, and flexibility. It can act as a retirement bucket, an opportunity fund, or a reserve for the unexpected. Unlike corporate money, it is personally accessible without creating another future tax bill. An RRSP may still make sense when the owner is in a high personal tax bracket, wants the deduction, and has a clear reason to pay salary. But it should be used strategically, not automatically. Corporate investing makes the most sense when there is true surplus cash that is not needed personally, and when the owner is intentionally managing the passive income consequences. And a holding company may become appropriate when retained earnings have grown enough that asset protection, long-term reinvestment, or future sale planning starts to matter. So, the smarter question for business owners is not, how do I maximize RRSP room? But rather, what gives me the best long-term after-tax outcome? Sometimes that means salary. Sometimes it means dividends. Sometimes it means keeping more capital inside the company. And often, it means combining these tools in the right order rather than overcommitting to just one. That is where real planning happens. And that is where business owners can stop chasing tax headlines and start building wealth with purpose. For more smart and practical financial planning ideas that help you avoid costly lessons, make sure to hit that subscribe button. Until next time!